Deferred revenue expenditure. Dear students, today we will discuss about as to how to deal with deferred revenue expenditure, development expenses, structural alterations, replacement of old works with new, general broad rules, and an illustration with a solution on the subject. Deferred revenue expenditure. Where heavy expenditure of a revenue nature is incurred, the benefit of which is likely to extend beyond the year in which it takes place, it is customary and legitimate to allow such an expenditure to be temporarily capitalized and to be spread equally over the number of years for which it is anticipated the benefit would be enjoyed by the business. It need hardly be stated, however, that as to within what number of years the whole amount should be written off will depend on the circumstances attaching to each particular case. Items such as preliminary expenses, brokerage on shares, and cost of issue of debentures or discount on issue of debentures, as explained above, may well be classified under this head. Further instances of deferred revenue expenditure items are cost of removal of business to a more convenient locality, cost of removal of works and the incidental expenses incurred in connection with the dismantling, removing and re-erection of plant and machinery, exceptional repair of a non-recurring nature by way of overhauling of the entire plant or a section thereof, advertising payment made under a contract extending over a term of years or an abnormally heavy amount expended on advertising in any 1 year in order to popularize a new product. In all such cases, inasmuch as the benefit to be derived from the amount expended would last for a number of years to come, it is deemed sound and equitable that each of these years concerned be burdened with a proportionate share of such expense, and not that the whole amount be charged off to the revenue account of the very year in which it had been so expended. Development expenses. As each business is started with a view to earn income in a specific direction, it is but necessary that all expenditure incurred up to the stage at which the business may be said to be sufficiently equipped to earn should be capitalized. But once the income has begun to be earned, a most careful distinction will have to be drawn between capital and revenue expenditure. Thus, in tea, rubber, and other plantation undertakings, as also in mining concerns, all expenditure incurred during the period of development and up to the time that they reach the profit earning stage is treated as capital expenditure. After that, only such expenditure as would add to the earning capacity of the undertaking as originally equipped by the acquisition of an additional asset or improvement of an existing asset would be treated as capital expenditure. Similarly, on the flotation of a new manufacturing concern, all revenue expenses incurred up to the time that such concern is able to commence working can be capitalized and added to the cost of construction of works. Structural alterations. Where structural alterations are made on property to satisfy local bylaws but which do not in any way add to the revenue earning capacity of the asset, or where alterations have to be made on an existing asset so as to put it in proper repairs, the amount spent should be charged to revenue. However, where alterations are done to any existing plant whereby its efficiency or capacity is increased, such cost may fairly be capitalized. Further, if as a result of alterations done on a building, the latter is made to produce more rent, the expenses involved can be treated as capital expenditure. Similarly, if a theatre or a cinema hall is refurnished or structural alterations are done thereto whereby attractiveness and comfort are considerably added to so as to result in additional revenue, the amount expended will be treated as capital expenditure. But if the expenditure is by way of repainting and putting the property in thorough repairs, the same must be charged off to revenue, although an abnormal amount spent in this manner may be treated as a deferred revenue expenditure item and spread over a reasonable number of years. Replacement of old works with by new. Occasionally, old works have to be pulled down and reinstated by the new works of greater earning capacity, or the existing plant has to be discarded due to new inventions and replaced by one more costly and efficient one. Such a circumstance would call for a careful adjustment between capital and revenue, and the important point to be decided is, should the loss represented by the book values of the asset discarded be considered as a part of the cost of the new equipment and capitalized? For example, take the case of railway station originally costing 1 crore having now to be replaced by a new and large one costing 2.25 crores. The question that arises is, what proportion of 2.25 crores should be charged as capital expenditure? In such a case, the one method usually followed is to capitalize the entire present cost of the new equipment and to charge off to revenue the book value of the old asset plus the cost of dismantling less the profit from the sale of old materials, if any, and the value of the old material utilized in the new construction. A more conservative method would be to charge off to revenue the present cost of replacement and to capitalize only the actual betterment. General broad rules. The following broad rules can safely be laid down. Capital expenditure is visible and is represented by an asset or improvement in the value of an asset and serves to increase the profit earning capacity of the undertaking, whereas revenue expenditure simply maintains an existing asset but does not increase profits. B. It is not sound to capitalize permanently an expenditure that is not represented by any asset. C. When an asset is replaced by one more efficient and costly than the original, the capital value of the old asset remaining in the books must be written off and the cost of the new asset must be capitalized. A still better method to follow under such circumstances would be to estimate the present cost of the replacing the old asset exactly as it stood and to charge this amount to revenue after deducting therefrom the amount realized on sale of old materials. The balance of the amount expended representing as it would be the actual cost of additions extensions should then be capitalized. Illustration. The modern industries removed their works to a more suitable premises and they incurred the following expenses. A. Sum of 47,500 was expended on dismantling, removing and reinstalling plant and machinery and fixtures. B. Removal of stock from the old works to the new one cost 5,000 rupees. C. Plant and machinery which stood in the books at 7,50,000 included a machine at book value of 17,000. This being obsolete was sold off at rupees 450 and was replaced by a new machine which cost 24,000. D. The freight and cartage on the new machine amounted to 1,500 and the erection charges cost 2,750. E. The fixtures and furniture appeared in the books at 75,000. Of these, some portion of the book value, rupees 15,000, was discarded and sold off at 6,000, and the new furniture of the value of 12,000 was acquired. A sum of 11,000 was spent on painting the new factory. State which item of expenditure would be charged to capital and which to revenue. Solution. Let us discuss each item one by one to find out as to how to treat the above expenses. A. Sum of 47,500 was expended on dismantling, removing and reinstalling plant machinery and fixtures. Solution. Rupees 47,500 expended on removing and reinstalling plant and fixtures will have to be treated as revenue expenditure. In view of the fact, however, that the benefit to be derived from the removal will last for a number of years to come, and in view of also of the fact that the expenses is of a non-recurring nature, there can be no objection to its being treated as deferred revenue expense item and spread over a term of years, say from 3 to 5 years, and a proportionate amount charged to each year to revenue. B. The removal of stock from old works to the new one costing 5,000 rupees. The expense incurred is removal of stock may also be dealt with in the same manner as above. C. Plant and machinery which stood in the books at 7,50,000 included a machine at book value 17,000. This being obsolete was sold off at rupees 450 and was replaced by a new machine which cost 24,000. The difference between the book value of the machine sold, that is 17,000 and the amount realized, that is 4,500, will have to be charged after revenue as depreciation. Rupees 24,000, the cost of new machine, will have to be capitalized. The freight and cartage on the new machine amounted to 1,500 and the erection charges 2,750. Solution. 1,500 expenditure on freight and cartage and 2,750 on erection of the new machine can be debited to plant and machinery account and thus capitalized. The fixtures and furniture appeared in the books at 75,000. Of these, some portion of the book value of 15,000 was discarded and sold off at 6,000, and the new furniture of the value 12,000 was acquired. Solution. In this case also, the difference of 9,000 between the book value of the furniture discarded and the amount realized therefrom will be written off to revenue account and the cost of the new furniture will be capitalized. F. A sum of 11,000 was spent on painting the new factory. The sum expended in painting the factory cannot be treated as capital expenditure but will have to be charged after revenue. It may, however, be distributed over a period of 3 years in order that the revenue account of any 1 year may not be burdened with a heavy expenditure of a non-recurring nature. In the next lecture, we will discuss about fixed capital, floating capital, valuation of fixed assets and floating assets.